How to sell a tax deed property in Florida. Florida's tax deed properties are a big treasure chest of money if you know how to do it correctly. And in this video, we're going to show you how to do it quickly and the most effective way to put cash in your pocket. Number one. Number two, we're going to show you how to avoid some taxes in this whole process also. But most importantly is how to avoid all the pitfalls. Stay to the end and we'll show you how to do all those. Okay, let's start at the very beginning. How do I acquire a tax deed in Florida is very simple, okay? Kind of, okay? First of all, I get people who say, I want to get the property each and every single time. But then you want to go to a tax deed sale. And Florida has two types of sales. Number one, they have a tax lien sale. They have these every single year. They have to start on at least the last business day of May and go until they've sold every tax lien in there. The ones that haven't sold go into inventory. Here's the nuance of it. When somebody buys a tax lien certificate in Florida and the redemption period comes to an end and the property owner has not paid on that, the tax lien investor doesn't actually foreclose on the property. It goes back to the county. They foreclose on it and it goes to a tax deed sale. So this is how you can acquire the tax deed each and every single time. If you don't want the lien and you want to go right to the property, that's what you do. You go to the tax deed sale. So understand the difference between the two. And we'll start with that. So if I want to get a property, a tax deed in Florida, you avoid the tax lien sale and go right to the sale. Now understand, in the state of Florida, when you go to a sale, live or online, and you put your hand up or click that button, you do own the property. There is no redemption period. There is no grace period. There's none of that stuff. You own the property right away. So the first thing you want to do is start to clear the title. Wait a second, Sean. You said I own the property. Why do I have to clear title? Understand, you're in a foreclosure. So they can't clean off all the old mortgages and stuff like that until it's gone to a sale. So you buying it is to the point it's at the sale. Now you can eliminate all those things on there. That does not mean that any of these people can come back in and satisfy the lien. They've had that opportunity up to the sale. You put your hand up, you're the successful buyer. Now you go ahead and clear the title, uncloud the title. In other words, all of those mortgages or whatever's on there, doesn't matter, there could be nothing on there, it cleans the title. In fact, from time to time, we'll deviate from Florida, you will find in different deed auctions out there, every once in a while, a county official will come up and say, hey, the family is trying to clean the title on this property. Nobody bid on it, and it goes up to a tax deed sale. Nothing survives a tax deed sale, so it gives that family the opportunity to really start fresh. You get 200- and 300-year-old titles on property, and what they want to do is scrub them clean and get rid of everything on the property. Okay, let's get back to Florida. So now that I have this property and I'm hiring somebody to clean it off so I've got clean title on this, why is that important? Well, I could sell it if somebody's willing to buy a property with old stuff on there. It's not going to be relevant, but it's going to look like, I'm not sure about this. Okay, so what you want to do is immediately do that. Once you're in that process, and again, this doesn't have to happen in sequence. It can happen simultaneously. As I'm cleaning up the title, now I'm cleaning up the property. Okay, so I got to decide, what am I going to do? Am I going to wholesale the property? That could be one thing. Now that I'm clearing up the title, maybe I just don't do anything to it. Let's just use a hypothetical situation. Let's say I buy a ARV is $250,000 property. I spend $90,000 on the property and I'm going to wholesale it. So first thing I'm going to do is clear the title up on the property and maybe I wholesale it out for $120,000. Did the buyer get a good deal? Absolutely. Did you make some money on the deal? Yeah, probably 20 net at the end of the day after cleaning up the title. It's not bad for a quick turnaround. So that is one thing I could do. The next thing I could do is say, well, wait a second. What if I did clean this property up, not just the title, but I'm talking about the property, clean it up, put some makeup and lipstick, as they say, make it look nice, rent the property out and start getting some rental income. So now I'm starting to get in some calculations. I'm going, well, wait a second. If I'm renting this property out for $2,500 a month and I've got $90,000 into it, plus maybe, I don't know, $15,000 worth of rehab, so $105,000, $2,500 a month, or okay, about $29,000 in income. I'm not doing the math, it's just my head. Back out your expenses. Well, that's over 20% cash on cash return. I don't care where you are, that's a good rate of return. So all of a sudden you're thinking, maybe I should rent the property out. That's one thing. Now, what do you do when you hold the property longer than 1 year? That's right. You avoid short-term capital gains. So now immediately we're going into another game. I've got some rental income coming from this, but I've also got $90,000 to $110,000 tied up in this particular hypothetical situation. So, okay, what do I do? Oh, I go in there and I pull money out of that in the form of an equity line on this property, and I go out and I do another deal. So now I've got that money working for me. I've got the cash coming from the property, and I'm doing another deal. So that just keeps cycling it over. Again, you've heard me talk about taxes and the tax code. That's the reason that the code is written the way it is to encourage us to keep it in there. See, if I go ahead, let's go to the third option, I fix the property up, I make it look all shiny, somebody comes in and buys it, yahoo! I sell it for $130,000, I pay my real estate commissions, I back out my costs, I put $100,000 in my pocket, and I go buy a big steak. Then I gotta write a check to the IRS. And if you're in the wrong state, that could be as high as 54%. If you're in a state without income tax, you're going to drop that down to about 40%. But still, that's almost half of your money is going to the government. You're kind of looking around going, wait a minute. That's why it's so important to understand what are the ramifications of everything what I do. Because I'm thinking, I got $100,000. The inexperienced investor is going to say, well, I could live real good. That's more money than I made at my job, until they take 40 to 50% of that, boom, on day one in taxes. That's not a good way to do it. So, but it could be the way you would make it. Hey, I'm doing so many deals, I'm okay with that. I want to pay the tax on it. And the final way you could do that is you can go ahead and sell it or purchase the tax deed in the first place in your retirement account. In that respect, when you buy it in your retirement account, you're avoiding all tax on it. So it kind of it opens up a whole different plethora, if you will, of different options that you have on that. I'm getting hooked on that word plethora. We'll stop using that, but you get what I'm saying. It's a whole gamut. There we go. There's a new word of different opportunities there. So those are just a few of the ways you can make it happen. But again, you don't have to be married to a situation going in. I always love to say this. Let the property tell you what to do. Okay, so if I get this property for $90,000, and as I'm clearing up the title, I go and look at the property, oh my gosh, it doesn't need anything, okay, it might be telling me to go ahead and sell the property and go do another deal, okay, because it's inside my retirement account, all right, or it doesn't need anything. I'm going, God, I can rent this thing out and probably net $22,000 a year. Still pull some cash out of this deal and do another deal, which will drop that cash flow down a little bit, but now I'm cycling money. You start building 10 or 15 of those properties that you own, 50 cents on the dollar, that's called legacy wealth out there. So many different options when you're selling a tax deed in Florida that literally the options are unlimited. Now listen, I've got a full-blown class specifically on this. If you want more information, just go to higginsmethod.com, click on that link, and I've got a free class specifically for you.